Eric, it was great to have Louis back on the show. Now, listeners, you're going to find the download link for this week's Trade of the Week in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at macrovoices.com. Just go to our homepage and look for the red button over Jim Bianco's picture saying looking for the downloads.
Patrick, for this week's Trade of the Week, Louis Gav argued that this isn't just an energy shock, but the beginning of a broader shift towards strategic commodity stockpiling across energy, agriculture, and industrial inputs. So how do you position for that theme without simply chasing the latest headline spike?
Now, Louis' argument is that this isn't simply an oil story. It's a broader wake-up call that the countries and corporations can no longer rely on just-in-time supply chains or financial reserves alone to guarantee access to essential commodities. As a result, Louis suggests we are entering a new phase where strategic stockpiling of physical commodities, everything from energy and fertilizers to industrial metals and agricultural inputs, becomes a structural trend rather than a temporary reaction to geopolitical headlines. So rather than chasing short-term price spikes in one isolated commodity, this trade is about positioning for that broader rebuild in physical inventories across the commodity complex through the Invesco DB Commodity Index Tracking Fund, ticker DBC, which provides diversified exposure across the commodity space. Now, what makes this setup particularly interesting is that much of DBC's rally this year has been driven by its heavy oil exposure, with roughly one-third of the ETF tied to WTI and Brent crude futures. That has helped drive the ETF to gains of as much as roughly 41% year-to-date at the peak. But it also leaves the trade highly sensitive to every headline surrounding the Strait of Hormuz and the Iran conflict. A credible peace deal or a de-escalation could easily trigger a short-term pullback in crude oil prices, creating downside pressure on the DBC, even if Louis Gav's broader commodity stockpiling thesis remains intact. And that's why, rather than taking outright linear exposure through the ETF itself, I want to introduce convexity into the structure to maintain upside participation in longer-term commodity story while better defining downside risk if the geopolitical premium temporarily unwinds. From a trade construction standpoint, rather than taking outright exposure in the ETF itself, I want to express the view through a longer-dated call option on the DBC to introduce convexity and define downside risk. With the DBC trading around $29.80, the structure uses the January 15th, 2027 $30 strike call option with roughly 253 days to expiration, trading around $3. The objective is to maintain upside participation if the broader commodity stockpiling thesis continues to unfold, while limiting downside exposure if short-term geopolitical de-escalation triggers a pullback in crude oil and the broader commodity complex. The result is a defined risk way of participating in the longer-term commodity stockpiling theme without needing to absorb the full volatility of the underlying ETF.
Patrick, every Monday at Big Picture Trading, your webinar explains how retail investors can put on our most recent Trade of the Week. For those listeners that want to explore how to put on these trades in greater detail, don't miss out on a 14-day free trial at bigpicturetrading.com. Now let's dive into the post-game chart deck.
All right, Eric, let's dive into these equities.
Patrick, one thing's clear, this market is rallying and rallying strong, even if it's on still unconfirmed rumors that a peace deal might be in the works. So it seems that only outright disaster is going to stop this S&P rally. But the broader market is still seeing plenty of new lows. So breadth is the big thing that's missing from this rally. I used the big move higher on S&P futures in the early hours of Wednesday morning to add to my downside hedges. Now, obviously, that position has already moved against me as the rally has continued even higher since then. But frankly, I have no regrets. I'm glad to be hedged in these uncertain times. And I think the fog of war, frankly, just got thicker. What I mean by that is President Trump is now past the 60-day rule. He's not supposed to have any kind of foreign conflict without congressional approval that goes beyond 60 days. Well, if we're past 60 days, what the Trump administration has been relying on is their dubious contention that, well, since we have a ceasefire on, the 60 days doesn't count because the ceasefire began before the 60 days was up. Well, if that's the story and that's the story they're sticking to, they got to continue to pretend that there's a ceasefire on, whether there really is or there really isn't, because otherwise they have a congressional oversight violation that they have to contend with. So I think it's going to be even less certain as we move forward exactly what the situation is. In the case of Wednesday's news, which collapsed crude oil futures, that only lasted a few hours before Iran basically said, no, we don't agree to all of that, and we don't think that the terms are reasonable. Now, despite the fact that Iran basically said, nah, it didn't really happen, the market didn't even come close to a full retracement. So there's still plenty of hope in the system. I'm just not sure exactly why.
Well, Eric, what is clear to me is that the broader intermarkets do care about what is happening in Iran, and its impact is on oil and interest rates, inflation expectations, bonds, and so on. But right now, the equity markets are marching to the beat of their own drum, driven by this new parabolic rise in the semiconductor index. We just simply have not seen this type of burst higher going back through, a 5-year look back. This has just been an extraordinary rip on the upside. This is a very thin market. We continue to have the breadth of the market remain sticky around 50-55%, which means half of stocks are in a downtrend. We don't have any broad buying happening here. And even the Mag 7s as an index have not been able to make 52-week highs, while obviously a few components like Google have certainly been able to clear that hurdle. The bottom line here is that the semiconductors are the ones that are the generals that are driving this. Now, we are seeing some extraordinary moves, including in the South Korean Kospi. Everything has gone full parabolic on the upside. And inevitably, all parabolic moves have blow-off tops and mean reversion. And I think that the story of the S&P is going to be at this point linked to this. Now, will we have a broadening of the breadth? Will we see sector rotation once we see some sort of a short-term blow-off? Those are the puzzles to solve to determine what's next for the S&P. At this moment, though, the S&P 500, again, it seems to be just marching to the beat of its own drum and not being driven by the macro and geopolitical circumstances. All right, let's move on to the dollar here.
The gradual decay in the dollar index on peace hopium confirms my view that when the Iran conflict is really and truly over, the next move for the dollar is going to be down. The thing is, I still am not persuaded that it's over, and we still have a big unfilled gap on the chart all the way up to 99.39 on the Dixie, which is now well above the market.
While the US dollar remains range-bound, the story definitely is about the intervention with the yen. We had a material turn higher, and the big question here, are we going to see some a big yen move, and what kind of an impact will that have? At the same time, we're seeing that the headlines about a potential de-escalation certainly popped the euro, not only in the Euro stocks, but also the currency and so on, all reacting to a potential de-escalation. So that puts the dollar in a bit of a muddle and certainly vulnerable for actually trading back to the bottom end of that trade range. Not super bearish the dollar, but I don't see any immediate catalyst. The dollar going higher was very much a risk-off kind of scenario, and that simply has not materialized in spite of the escalation in Iran. All right, Eric, let's touch on crude oil here.
The big price collapse came on an Axios report that a deal for a permanent reopening of the strait was finally on the table, and the parties were just inches away from final agreement. Should be out within the hour. Except then a few hours later, Iran refuted that and said that they didn't think that the terms being proposed were realistic or likely to go anywhere. Interestingly, we only saw a partial upside retracement after Iran refuted the original report. I don't see a deal coming together, at least not yet. Trump has been absolutely adamant that he will not tolerate Iran having a nuclear weapon or having an intact nuclear weapons program. Iran, on the other hand, has been absolutely adamant that they're not willing to give up their enriched nuclear material. So it seems like they've got irreconcilable differences. On the other side of that coin, both sides, in my opinion, are losing staying power. Trump has passed his 60-day limit with no congressional approval, so he has to at least pretend that a ceasefire is still in play, whether or not that's really true, because he doesn't have another good explanation for why he's beyond the 60 days and still hasn't obtained congressional approval. And we're finally reaching the point where Iran really is running out of time, as has been alleged several times previously. The blockade, as long as it stays in place, really is having a crippling effect on Iran's economy, and it's starting to come into serious question as to how long they can last. So both sides are really being tested on their staying power. They had both, I think, been overconfident in their ability to outlast the other side. I think they're now both getting a dose of reality, and I'm not sure who's going to crack first. But at this point, I don't see them coming together and kissing and making up. I think we still have a ways to go on this, and I won't be surprised if there's another cycle higher on crude oil prices. Now, to be sure, this will be over someday, and when it is, crude oil prices will come down and probably come down dramatically, at least at first, because of the UAE's move to come out of OPEC. Everybody is expecting UAE to overproduce. But that's when we actually get the Strait opened again, and I don't think we're there yet.
Well, Eric, it is clear that the front end of the curve is going to be highly sensitive to the next headline coming in. This is where I want to continue to turn my attention, going a little further out on the term structure and looking at, for instance, crude oil, where it's trading at the end of the year. This is a little bit less volatile and generally is where we'll see some buoyancy, as there's going to be logistical problems with moving oil, and it's going to take much of the year to resolve itself, including potentially countries spending a lot of time replenishing inventories and strategic reserves. This is going to be the question as to, in my mind, as to even if there is this short-term drop in the front months or a huge rip in the front months, what will happen to the longer-dated contracts, and where's the longer-term fair price of oil going to settle from all of the logistical issues and supply disruptions? All right, Eric, let's move on to gold here.
Well, I've really been bitten by Murphy's Law this week. Gold is back well above 47.30, which is where I de-risked my gold position last week. It had gotten down all the way to 45.20, so it was more than $200. I guess I made the right decision at first, but the unexpected news on Wednesday of a supposed ceasefire deal being imminently in the works is very much behind the collapse in crude oil prices and the brisk rally higher in gold prices. I have not re-risked my gold position, however, because I'm not persuaded that this is over yet. I think we're operating on hopium here. Now, to be sure, both the stock market and the gold market are rallying and rallying strong, and maybe I'll be left behind, but I'm not going to get whipsawed here, and it feels to me like this is not really over. We'll see what the market will bring.
Well, what is clear to me, Eric, here is that gold remains highly sensitive to rates and oil. As oil moves, rates move, and gold responds. And so the path of gold here, I think, is going to be a broader geopolitical and macro story. If we see again another pivot on whether or not there's going to be a peace deal, then gold can very quickly just give back all of these gains. At this stage, that long-term gold bull thesis is going to have to wait till everything settles in and this consolidation finishes before we can see some structural bullishness. All right, Eric, what are your thoughts here on uranium?
Well, we saw a big surge higher in sympathy with broader market strength on war ending propaganda, rumors, whatever you want to call it. I am not at all persuaded that that's over. And if we do see a move lower in stocks, at least temporarily, it will take uranium down with it. Frankly, I would welcome that as a buying opportunity because I think what we're seeing now is that it's very clear that when this Iran conflict is over, both the broader market and uranium are headed higher and probably much higher. So I'll welcome an opportunity to buy the dip if we get one. But for now, the market's looking really strong. And we've got big news for people who followed me into the investment in Alo Atomics, the company that Matt Lozak runs. Matt was interviewed here on MacroVoices on our March 5th episode. Alo has had their DSA approved. The DSA is essentially the operating license from the Department of Energy to run their reactor. It basically allows them to now turn it on. This is the reactor that they built in just 40 days. This company is amazing in terms of how quickly they get things accomplished. I wrote a whole Substack piece called The Race to Reactor 53. That's on my Substack. It's linked in your Research Roundup email. You can read all the details there, but the gist of it is there are several companies racing to become the new first-of-a-kind nuclear reactor to be taken critical at the Idaho National Laboratory in almost 50 years. It's actually 49 and a half years since in 1977 the last nuclear reactor was taken live before the NRC started standing in the way of progress, quite frankly. So the whole story is on my Substack. You'll find it linked in Research Roundup. The reason this is of particular interest to those of you who invested in Alo after Matt's interview is you would have invested at a $2 billion company valuation cap in either the SAFE or the SPV round that followed that MacroVoices interview. Both of those rounds are closed and will not be reopened, so it's too late for those. But already after the DSA news, there was so much new investor interest that the company has now launched a new SPV round that they're going to conduct before their Series C, and that's at a $3 billion valuation cap. So that means effectively, assuming that you count an up round as a mark-to-market event, those of you who invested at a $2 billion valuation are already up 50% on the investment that you made a month ago. And expectations are for an even higher Series C pre-money valuation because it's very likely that the company will achieve that goal. Whether or not they actually become the 53rd reactor, the first of several companies that's competing to cross that finish line before July 4th, it's not really certain. They've got some stiff competition, but I don't think that matters, frankly, who's first. What matters is that before the Series C is priced, they've evidenced criticality and they've brought a first-of-a-kind reactor critical at the Idaho National Laboratory. I do expect that to happen before July 4th and before their Series C is priced, and that means we'll probably have yet another up round and a further increase, although it's not liquid yet, our unrealized gain in this rather exciting investment. So that's the update, and congratulations to those of you who invested in the company.
Well, Eric, uranium remains very quiet and inactive. It's certainly not getting the attention, and nor is it getting huge geopolitical swings. At some stage, this market will wake up again. But right now, this is not drawing the attention of investors. But what is copper. I wanted to just have a quick look on that copper chart, which I have on page 8. And what we see here is a consolidation back to its 50-day moving average. We have a clear attempt to break out to fresh new highs. Now, while copper back in January did trade over 650 on the upside on an intraday basis, we are on a closing basis now back to 52-week highs. Is this breakout in copper real, and will it follow through, is certainly something that I'm going to be talking about with my members.
Patrick, before we wrap up this week's podcast, let's hit that 10-year Treasury note chart.
Yeah, on that 10-year Treasury yields continue to have that direct correlation to crude oil. Crude oil up, yields up, crude oil down, yields down. That right now has been working. It will eventually decouple, but right now in the heat of this geopolitical circumstances on an intermarket basis, this correlation is driving it. So at this stage, I wouldn't be trying to make a forecast independent of where the next move on crude oil is going to be.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview, as well as the Trade of the Week chart book we just discussed here in the postgame, including a number of links to articles that we found interesting. You're going to find this link and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main account on X at MacroVoices for all the most recent updates and releases. You can also follow Eric on X at Eric S. Townsend. That's Eric spelt with a K. You can also follow me at Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.